Welcome friends once again to our NPTEL MOOC module on health economics. We have been discussing a number of issues related to health economics, especially emphasizing in this week on economics of health system. As I already mentioned in my previous 3 lectures in this particular week, that how health system is indeed defined. We know that health system in Indian context is very complex. So our attempt is redressing the complexities and somewhere clarifying the possibility of a base health system. Hence we are actually understanding its criteria, and sometimes we also understand whether a package, health package maybe through insurance is actually redressing the problem or not, how far the quality is dealt. So without delay, I think I am just proceeding. In the previous lecture, if you remember, we have discussed about social health insurance mechanism. Today hence we stick to our specific context on understanding the private financing mechanism, where largely we will be emphasizing the role of private insurance premiums, etc. So what are the directions? Of course, the clarifications we are going to make it in terms of out of pocket payments. Largely we mentioned in our very introductory lecture on how Indian patients indeed are actually bearing the larger burden. Their out of pocket expenditure on healthcare is very huge. Still 2/3 of the health spending is from the is indeed from their own pocket. And of course, we as a developing country where massive percentage of people are in the bottom line, or their income quintile is very low. So it is quite expected that they will be depending on social insurance packages. However, if the private mechanism works, how far these mechanisms is efficient and how far we can understand the burden on people. Even how much of that amount each individual is expected to pay, what is their willingness to pay, etc., will be emphasizing. Hence, our focus will be on two important aspects, that is on voluntary health insurance, their strength and weakness, as well as emphasizing on the on moral hazard issues. If the insurance is taken, then how far the insurance is misused or overused. These aspects will be discussed. Now we are just clarifying what we have discussed at the end. In today's lecture we have highlighted, we discussed on tax based health insurance and social health insurance, and now we are actually discussing on private health insurance. The previous 2 points were discussed in our previous lectures. And as I already told you, the 2/3 is dependent, out of pocket expenditure is actually dependent on private spending, or the out of pocket payment is actually explained through private spending. Hence, we will be discussing on what is voluntary health insurance and whether it is fully or partly dealt with the health premiums. So private financing mechanism is all about explaining that no system fully relied on, and fund specific parts of the system or specific services or specific groups. Now, what are the criteria of the out of pocket payments? We may directly pay at the point of use by the patients. We will also see how the at the point of pay has certain relevance in terms of moral hazard issues. We will be also explaining this. Then if it is completely market based mechanism, does it have any wrong signals in terms of externalities? Is or the market is functioning very well, like some of the health care tools or drugs, etc., are not necessarily expected to be rationally settled in a market mechanism that may request regulated markets mechanism. Simply when we say market, we refer to free market. The market charge the prices for the services, and there are profit operators as well in informal sector, and hence we will be discussing on prices and quantities based on the interaction of demand and supply. Another aspect we used to discuss in healthcare context is on rationing. That's strictly based on what is the willingness to pay and the ability to pay. So rationing must be in place to guarantee the resources that are to the highest priority applications. Then it has to be through equity and incentive, how far the affordability is a concern, hence if any policy or any scheme is being floated or being introduced, how far it addresses the issue of affordability. It is another important criteria to be discussed, and an indirect incentive or direct incentive for a better care is also expected. So, the burden of payment cannot be redistributed and that is usually discussed in the context of equity. Some of the examples to check this out of pocket payment is that a market for drugs, especially the prescription related drugs, operates in almost all countries and usually these are highly regulated, and usually the sector is in consultation with the primary care doctors. Now, properties of out of pocket payment based on certain criteria such as I already mentioned, those are payments, market, rationing, equity and incentives. Then only the health system is expected to be better. Now, we are discussing the features to identify or to explain the health system. One is stability and when we say it is market based, the predictability is very I mean it is expected to be unpredictable to a large extent, and basically in that case this is less predictable than regulated or monthly or annual direct tax or SHI social health insurance contribution based mechanism. Regarding transparency, we have mentioned here that direct and transparent link between payment and receipt of the services, it is considered to be positive, okay, and and moral hazard issues arises. So we said the problem of moral hazard do not apply in a market based mechanism. Because you are supposed to pay as per the expression of demand or willingness to your payment, hence overuse is considered to be less, hence we have indicated as less of moral hazard is expected. Equity, indeed in some of the countries context market mechanism does not work well. There we refer to the context of inequity largely. In market based usually not offered to those with inadequate ability to pay regardless of their need. Even if their need is higher, like poorer sections, people used to carry a poor health in their early years of their life. Hence in the later part of life the probability of their health conditioning is expected to be poor as compared to the richer sections. Hence they deserve more health care services, whereas the market is not going to regard the justice in terms of equity. Another, we just say administrative cost, we just say it is neither higher or lower, it based on which kind of rates are charged, whether it is flat rate, and the payments basically our purpose at this moment is to discuss OP, out of pocket expenditure given market structure, market mechanism. Okay. So, our positive or negative directions are based on these two variables, and here we say yes, to make a health system better we need to have certain flat rate. If flat rate charges are there, payments are on the basis of a flat rate, administrative cost could be low relative to revenue generated. When the cost of payment or the payment rates are complex, hence it requires huge administrative cost, and the implementation is actually difficult. Hence in this case it is negative where it is positive. Okay. So, these are some of the features usually discussed in the context of healthcare. Now, we are further clarifying these pages from the reference of work staff. We will also discuss work staffs and their contribution in other chapter such as demand for healthcare disparities, etc. Then especially the case of high need for care with low ability to pay, out of pocket payment systems are likely to impose catastrophic or impoverishing illness cost as mentioned by work staff, or inhibit healthcare delivery to those most in the need. So, this is what is emphasized by work staff, and this discourages important health seeking behavior leading to untreated cases and delays in treatment as well. Okay. Now, there are some policy implications such as mitigating negative impacts, and there are graduated payment structures can be also considered, and some of the examples like exemptions or lower charges for the lower income group, etc., might be helpful. Now, we are discussing the context on externalities. If you go by the microeconomic principles, you you might have read the context called externalities. As we know that in wherever there are externalities problems, maybe positive and negative, the free market mechanism may not be the right choice, may not settle the best social value. Okay. And this is largely applied in the context of healthcare and eventually its impact on the out of pocket payments. So, hence the issues of out of pocket payment in the context of externalities should be re-emphasized. We are just discussing some cases of drugs. We know that drugs is a very regulated market, drug market is very regulated. Yet there are number of private players. Those private players have enough options in terms of dealing with their profit maximizing strategies. However, some unrestricted use of drugs, if it is not 100% regulated or partially regulated, there might be some issue of antibiotics issue or resistant to antibiotics and anti-malarials. Like we have taken some drugs, but it's all its consequences are not well regulated. Okay, that might lead to resistance, and that resistance might create number of negative externalities on the body, because other medications might not be effective. Hence, dominant externalities are negative, and lack of information causes people to demand poor quality and inappropriate drugs that they would not demand in the presence of full information. Yes, externalities occurs of course largely due to information problem, information asymmetry. Okay. Yes, the social choice explanation emphasizes once again that since information is not complete in reality or in a complex healthcare system, social marginal value play important role. We discussed in our previous lecture while emphasizing on our social insurance structures. In our previous lecture on social health insurance mechanism, tax and social health insurance mechanism, we have discussed about how to draw social marginal value and demand curve, etc. SMB diagram. And we know that usually the demand curve which we draw it, if market is perfectly informed and all the entities are well informed, it is quite obvious that social marginal value is nothing but the demand curve. But when we know that the healthcare sector and its products are actually not reflecting its true value, hence the consequences are realized at different point of time. Hence, the social marginal value might be situated at the left of the demand curve, okay, and hence the optimal production level is exceeded. For other products, the reverse might be the case. The valuation which the relatively poor consumers can place on appropriate and effective drugs may be low. In this figure, on our next slide, we will discuss about these cases, how overvalued products are actually creating difficulties in terms of net losses to the society or problems to the society. And that is basically called the externality cost. Okay, a drug with a few effective and potentially harmful effects due to inappropriately prescribed and past its expiry date or poorly stored one is creating trouble. So, in our curve we will discuss about these emphasizing free market mechanism as against the externalities based marginal social curve. More regulated out of pocket payments can control some of the problems, we will also derive out of the diagram. Then regulated by what? Prescriptions requirement, products licensing, qualification standard and restriction on qualified personnel, etc. In this figure, we are actually discussing once again, we start with the market mechanism, free market demand curve, and this is our marginal cost curve for the healthcare product. Okay. And based on this, we are quite sure that B is the equilibrium point, and from the authors we derive that they mentioned the title as regulating an overvalued pharmaceutical product. Why regulation is required, we are just going to tell you. Now, let us start with this free market mechanism by which the quantity is actually this much q, small q is demanded, OQ is actually demanded and supplied. Yes, had it been a any pure economic good, we will not have bothered much for our explanation. Consumers would have paid the price P, and the maximum satisfaction to the society or that is called the surplus is reserved. However, given the context of healthcare products, we know that it exhibits externalities. In large cases there are negative externalities as well. Hence, we are supposed to understand marginal social valuation, and the marginal social valuation is usually after using the product, healthcare product, maybe the drugs, the patients or the individuals might realize that actually it is not worth paying of that amount for this quantity, rather less consumption would have been better. Okay. And given the cost, we are not now at this moment changing the cost structure, because we are not regulating at this moment, we are not emphasizing that there should be more regulation because of the overhauled overvalued pharmaceutical product. Given this context, we know that marginal social valuation is actually lower, hence there will be a backward shift of that curve, or if we derive two demand curve, this is actually real actual demand curve is MSB, market based demand curve is D. Okay. Given the actual valuation or the willingness to pay, consumers are actually paying Q star, okay, Q star, capital Q star, they are actually purchasing this, and hence we are quite sure that since they are Q star till Q is actually overvalued products by the market mechanism. Okay. And since all under the demand curve is willingness to pay, and finally the demand, they are under this demand curve, they are in fact there will be a possibility of loss due to the externality problem. Now, these are all explained here. Due to negative externalities or dominant externalities, a lack of information causes people to demand poor quality and inappropriate drugs. And this is explained through the MSP, which is lying left to the demand curve. Along the left of the demand curve, that is MSP, few effective applications of drugs, and below the quantity in the axis are explained through the negative social valuation. For many harmful applications, or in this case we mentioned as drugs, the shaded area, that is ABC, shows the welfare loss associated with the free market solution in comparison to the perfect solution. So, there are differences again. You may take a note what is called free market solution and what is called perfect solution. Okay. So, we have just mentioned that A, B and C, that is the triangle area highlighted, and even in this context the pure negative externalities over this consumption, not necessarily the entire consumption from Q star till Q is all negative externalities, some of the portion might be clearly emphasized exhibiting negative externalities. Okay. So, where we have just said that Q star of the drug is provided in the cases were actually most effective. Hence, since there are negative externalities and the welfare loss is highlighted, we we require regulatory options. We need to standardize our healthcare. We need to standardize at the Q star. If this is being purchased, is actually required by the demanders in the society. However, to standardize this, we might expect higher cost for the production. However, those are the free market mechanism principles, or the party to the supply of these products. They might demand higher prices for their quantities. Hence, the supply curve might be shifting upward or up left hand side or backward. That indicates a possibility of higher cost due to standardization, etc. So, we will be discussing that in our another chapter, clarifying all these things very clearly, and maybe somewhere we will be also emphasizing what really happens, how much quantity. Yes, number of things you can conclude. Yes, the extent of consumption now as per the free market mechanism after some standards might fall actually. Okay. So, we will discuss in detail later. I think at this moment we just wanted to mention that this calls for, this negative externalities calls for some forms of regulations. Okay. In the absence of alternative interventions, it might conclude that since the area DE is less than that of the area ABC, the regulation is inappropriate. Okay. So, now after basically what is explained, when MSP is actually clearly mentioned, with strong regulation, it might happen that your the regulating body might instruct the companies not to sell this quantity at all. Okay. So, when nothing is sold, so quantity supply and quantity demand will be at 0. Okay. Hence, this portion might again be added with the welfare loss. Okay. So, this is what we said, the ADE area, ADE. With in the absence of alternative intervention, it might be concluded that since area ADE is less than that of ABC, the regulation is appropriate. So, regulation is required. Now, in this case, we are actually eventually approaching to 0 supply and demand of the product, which is actually not good. Hence, some other proposition is expected that the healthcare product might be regulated. Those whoever are providing to the society, the private players, whoever are actually providing the drugs or supplying the drugs to the society, there must be some standardization. Okay. Hence, marginal cost might rise, and that may end up with a higher point of equilibrium at first the market equilibrium mechanism, and we might end up with lower quantity of sale, and again some calculation might be made in terms of net change in the externalities cost. So, since we have other things to be discussed, so I am just trying to skip this portion and let us explain other aspect carefully. Now, we are moving to another aspect called voluntary health insurance scheme as against the social health insurance scheme we discussed earlier in a previous chapter. We wanna know what really happens in terms of the cost to the society, okay, and what type of premium we are supposed to pay, and what should have been the maximum or the optimum premium is desired in the society, and the individuals will be ready to pay for it. Okay. So, these are the details I will be explaining in a short while. People will voluntarily choose to purchase such insurance only if they are risk averse. Okay. And we will also discuss this context in terms of risk averse, risk neutral and risk lover people. The extent to which individuals are risk averse determines the viability of insurance market. Risk aversion can be explained in terms of diminishing marginal utility of wealth. Again, risk averse etc. I think we discussed in our insurance chapter that insurance market usually go with an average calculation. They calculate all the kind of people with an average premium rate. So, that eventually end up with a problem to the insurance company, and it has a number of issues such as informational differentials, such as signaling issues, such as moral hazard issues as well. However, those who are in the upper segment of our society, or those who are at the verge of need for healthcare, they usually in a position to go for taking the insurance premiums. So, yes, but there is a possibility of high use of insurance, whereas larger segment of the people are poor in Indian context. They based on the average pricing structure, they may not able to purchase. Hence, insurance company is might be and is also shown, is also observed that they bear number of risk. Those aspects we discuss in our insurance chapter in detail. But at this moment, we wanted to understand one aspect that is called private health insurance, and what would through the voluntary health insurance scheme, and what would have been the voluntary amount that will be addressing the risk aversion and the maximum premium amount to be paid. Now, we will be taking two things to explain our theoretical explanation. Is presented here. We will be taking the help of diminishing marginal utility of health and expected utility of health theorem. Okay. We know that expected utility theorem or expected utility of our insurance payment etc. is not just based on our entire period of payment. It must be considered after the minimum value of health or minimum value of risk. If the individuals are risk neutral with respect to utility, they will still be risk averse with respect to income, since the actuarial payment would have a lower utility value than the utility cost of the event multiplied by its probability. So, we will be emphasizing on the actuarial payment as well as against their payment. Okay. We will be also emphasizing on two things, one with respect to utility and one with respect to income. Okay, one question you might note it very clearly. This is very important. Okay, that individuals are risk neutral with respect to utility. However, they will be risk averse with respect to income. So, we will try to prove this theorem through the approach. Okay, so now here is the diagram. We will be discussing one by one. Now, this graph has a clear presentation. On the horizontal axis, we have taken income, wealth as a proxy of income. In this side, we have taken utility. Okay, I am just giving you another clarification through this. Let me just erase at this moment. All right, and it might be useful for you. And all right, so let us go through our understanding. First of all, we need to present it here, our utility, diminishing value of its utility, that is which we have said here in the diminishing marginal utility of wealth. with the rise in wealth, the incremental change in the utility will eventually decline. And this is what is presented in our red line. Okay, that's basically called utility curve. And this is at this point our maximum utility is attained. However, our expected utility is mentioned here. Expected utility. This is basically our utility curve. Now, expected utility started through a minimum level. A minimum level of health onwards, we may project our expected utility. Below that, actually life may not even exist. We may not derive any utility out of our wealth. Below certain level of wealth, no utility for your healthcare is actually defined. Hence, a minimum amount is reserved. Now, at the same time, I want to also mention that out of our entire journey letters we have a certain risk bearing utility. If we wanna get more utility, you have to averse the risk. Okay. So, risk averse, let us assume we have 50 units utils for aversing the risk. Now, let us start by our wealth related discussions. Here I have clarified all these things one by one related to, now we have taken an example of skier. Okay, skier has higher risk of diving in the air. The graph shows the relationship between health levels and utility measured in imaginary utils for a skier. Okay. The skier considers the purchase of insurance against a risk of accident on the slopes. An accident would cost her 5,000 rupees, and there is a possibility of accident, and the accident if any insurance is not taken, 5,000 is the cost which we have mentioned in this diagram. Okay, then out of the entire wealth, 5,000 is actually lost. Now, the question is that 5,000 loss can be actually covered up with a 20% with a premium, and premium is actually calculated with a the chance of occurrence. What is the frequency or the incidence of or the chance of occurrence is 20%. Let us at this moment we assume 20% occurrence of this losses are there, okay, or incidents are there. Hence, 20% of the 5,000 would be actually 1,000. Okay, this is what is mentioned, and that is in fact called actuarial payment. That payment is needed, right? And that's basically probability of loss into the size of loss. Size of loss, it is 5,000 rupees and probability of loss is 0.20. So, that boils down to 1,000 rupees. So, 1,000 this is lost out of my total income, total health. Now, this portion is actually lost, and this is lost why? Because I am supposed to pay the income as insurance premium, and that is basically called actuarial premium. And if I am paying it, actually I am reserving till this point. Okay. Out of my total health I am attending this, but since I am paying, my total income now is lost and I am ending with this level of income. Since I have to pay it to the insurers, I have to sacrifice my utility as well. So, my total utility now is actually ended at this point. So, arbitrarily I am just mentioning let us 2 utils are lost. Okay, 2 utils are lost, and that is equivalent to my 1,000 as premium. Now, we are just trying to clarify that at this level the utility losses is understood. The utility loss is associated with paying the actuarial premium is 2 utilities which we have already discussed, and utility cost associated with the risk that is 50 utils. What is this 50 utils? At this level, what is the expected utility? It is actually equivalent to 10 utils. What is this 10 utils? Now, we are actually trying to map it in terms of our utility cost. It is not premium cost. There are 2 things we are clarifying. One is in terms of our income loss, another in terms of its utility cost. So, what is this utility cost? Given this income, what is the utility cost? The utility cost associated with risk is let us total risk is of 50 utils. So, how this 50 utils till the maximum amount we have just started with from the minimum level, and if it is of 50 utils and out of that there is a risk attached to our incidences or to the skiers. Okay, the skier is, if risk neutral, willing to sacrifice up to 10 utils. Okay, so then what is this, why it is risk neutral? We just let us understand why 10 utils are actually sacrificed. Look at this, these 2 points, we are just comparing this over this. So, to clarify why it is risk neutral, the skier is willing to sacrifice 10 utils, that is equivalent to, out of our 50 utils times 20% of our probability of this event or this incident. So, that is equivalent to 10 utils for the insurance, an amount which can be identified graphically on a straight line between the starting point and the point associated with the risk outcome. So, this is basically where we said this income which you have just finally ended up with, this is an expected utility. The consumers will derive an expected utility. Now, we are just trying to map the expected utility if the person is risk neutral. Okay. How is it risk neutral? Because still the expected utility and the total utility remain constant. Okay. Hence the consumer will be willing to pay, right, willing to pay 10 equivalent to 10 utils. Alright. Now, we are going to just mention that what is this equivalent in terms of income. Okay. What is this equivalent in terms of income? So, she is willing to pay up to 2,500 to achieve achieve till this level of utility. Okay. And we have already noted that this follows more utility diminishing trend. This follows that the more utility of well diminishes, the more an individual will be willing to pay for insurance for any given level of risk aversion with respect to utility. Okay. Now, it is expected that the risk aversion with respect to utility varies from individual to individual and is related to preference. Now, basically I want to mention here that to attain this level of utils, the consumer is actually willing to pay 2,500 as their income. However, this is their expected utility level is actually equivalent to the 1,000 premium amount. Okay. So, in any case the consumer has already attained the expected utility level, but still we are quite sure that consumer is willing to pay this, because they can attain the willingness to pay level by paying another 1,500, okay, rupees 1,500 amount. Hence, the the insurance will be exchanged only if the transaction cost and the profits can be contained with the 1,500 rupees slack between the actual fair premium and the maximum skier is willing to pay. So, if insurance amount if varies from 1,000 till to 2,500, still the consumer is considered to be risk averse and consumer is willing to pay. So, voluntary health insurance insurance offers cover for a specific package of healthcare benefits. And we have already mentioned this, we have already proved this as well in our theorem which I already said. The individual are risk neutral with respect to utility, which we have already said. They are risk neutral in terms of utility. However, they will be still risk averse with respect to income. Look at in terms of income, they are actually risk averse, their income actually reduced. Okay. Now, we are just summing up the VIH, voluntary health insurance. Just a minute. Yes. So, so it is VHI, voluntary health insurance offers offers cover for a specific package of healthcare benefits. You can read VHI as well. This is covering a proportion of all the cost of range of services and products which we already discussed. I think rest of the details you can easily find out. And we are now actually going to understand these as against other issues. Okay. like we have already discussed why it is risk neutral, how far it is risk equalization, etc. You can read between the lines, and whether prepayment is required or not. We will be discussing all these three concepts: voluntary payment, private payment, or prepayment, etc. In the context of moral hazard, to clarify this context further. So, now moral hazard is important, and that is basically discussed in the context of rationing. Price will not serve the function of a rationing mechanism. This is basically explained as the extent to which the insured when not faced with the price at the point of use, increase their use of services, okay, and that might lead to unnecessary use of healthcare, okay, and that is basically called moral hazard. It can only observe the resulting level of use which might have arisen from unavoidable risk and unnecessary use. We are just clarifying these moral hazard issues in the context of demand and supply for healthcare, and we will be comparing with full insurance issue scheme, deductible context, and co-payment. Co-payment actually we are referring to point of use, payment is made, point of use, and payment is made. Okay. Deductible at certain percentages is deducted from maybe from your salary. We discuss in our social health insurance scheme chapter as well. Hence, we will also be in a position to clarify the extent of moral hazard. Let us start with a typical demand and supply function for healthcare, and we start by a minimum level, as we already discussed in our different chapters, why minimum healthcare, and a minimum price is reserved. Below that usually the healthcare supply is not possible. Okay. So, hence MC curve is derived from a positive level, and that too from a minimum level of healthcare, that is reserved. Okay. Now, given the free market mechanism, we know that this is our Q star and this is our price for the service seeker to pay. And if it is the case of full insurance, and we know that and that the entire demand of the healthcare is actually be utilized by the service seeker or the health seekers. If it is completely free, then we may expect that till O to A is actually utilized, alright, given a full insurance scheme, or maybe we also already discussed in the context of social insurance schemes. Now, when when some forms of deductible are attached and which is silently deducted, certain proportion are deducted, we may not actually salary is deducted, but at the point of service we may not actually able to pay it. Hence, we are projecting on the same diagram. The demand pattern is not shifted much. So, in that context, since deductible our use will since a certain proportion of income we are actually paying, so the access of service might actually decline. Okay. Hence, our OB is actually utilized. So, the overuse which we said Q star till A is actually reduced. Now, it is only the moral hazard extent, the proportion of moral hazard will be reduced by AB. Now, if we see another context, that is the context of co-payments. Okay. If co-payments are there, we simply say that there are certain extra amount is attached for every unit of your from till these letters from B onwards we wanted to explain for co-payments, if any co-payments are attached. So, now what happened, for every unit of service you are supposed to pay higher amount of payment. Okay. Your price level actually for the every unit of service is expected to be higher. Okay. Yes, of course, when your point of service and payment is made, hence you have an a higher demand pattern, you might demand quality in the care. So, demand curve is expected to be shifted towards right, but it is not entirely shifted. We started from this level. Okay. Proportionally, we are actually shifting the demand curve based on the extent of payment, and if it is shifting towards right, what really happens, there might be further further reduction of reduction of our consumption of healthcare, and if the price is equivalent to P as per the free market price mechanism, if that is the case, still we are actually consuming less. Okay. Hence, the moral hazard problem is actually redressed. The entire amount which we said Q star A, that is excess demanded, is actually reduced through co-payments. Alright. So, though price in all cases price mechanism or the free market mechanism is a strong deterrence in terms of moral hazard problems, and it is considered to be a strong rationing given the society is even, whereas in other contexts where some co-payments and deductibles are there, yes, we can able to actually minimize our you know minimize our what is called moral hazard. Okay. So, all these details I have explained already. So, at price P, demand will be reduced to C, which I have already discussed in the diagram. So, what we have dealt so far? We have discussed the principles of price mechanism or free market based pricing structure to have a better health system. In that context, we also started comparing with the voluntary health insurance premiums or as against public sources or some deductibles, etc. There are a number of strength weaknesses as we identify through our diagram, and we also discuss about how the equivalent insurance is covered, what are the maximum amount of insurance premium based on the ability to pay of the consumer is measured, and we discuss in that voluntary health insurance diagram. And at the end we could able to discuss price based rationing mechanism as against the social health insurance scheme, as against some point of payment mechanism to reduce the issue of moral hazard. Hence, regulation is most required, but regulation with some mix of private mechanism is the best one. However, externalities are there, as we discussed. Regulation is considered to be the best solution. And here are the references for your ready understanding. And what is going to be there in our next lecture? It is about understanding the reality in terms of the health status in the world vis-a-vis India, and we also understand India's healthcare challenges. With this, I think it is time to stop. I look forward for your participation. Thank you.